So, President Trump just nominated Kevin Warsh to lead the Federal Reserve. And, folks, this is not just some run of the mill personnel change. This is a huge deal. It's signaling a massive, and I mean really volatile, shift in U.S. monetary policy. We're talking about a true regime change at the Fed for the first time in decades. And right away, the markets are freaking out. They're already calling it the war shock. What does that mean? It's basically an immediate, super sharp de-risking across the board. Investors have gotten used to 15 years of easy money, right? Well, now they're scrambling to figure out how to play a completely different game because a whole new era is about to begin at the most powerful central bank on the planet. All right, so in this breakdown, we're going to get into what this all means. We'll kick things off with the war shock itself. Then we'll get into the regime change and who Kevin Warsh actually is. After that, we'll unpack his strange hawkish-dove idea, figure out who wins and who loses, and wrap up by looking at what's coming next. Okay, first up, the war shock. The market didn't just ease into this. Nope, it was an explosion. Let's walk through the timeline and see just how fast things went sideways. I mean, the shockwaves hit instantly. On January 29th, just rumors sent Treasury yields flying. The very next day, the official nomination comes out and boom, gold plummets over 10%, silver gets crushed 30%. This wasn't just a little market trauma, you guys. This was a complete unwinding of a trade that's been on since 2008. The whole currency debasement thing. Betting on stuff like gold because you think the dollar's going down. And it didn't stop there. It went global. The South Korean market dropped over 5% because everyone's suddenly terrified of a dollar shortage. And all the while, the VIX, Wall Street's fear gauge, is staying sky high. Nobody knows what's next. So, to really get a handle on where we're headed, we've got to understand the guy taking the driver's seat. Let's talk about Kevin Warsh. Who is he? And what is this regime change he keeps talking about? Yeah, so Kevin Warsh, he is not your typical Fed chair. Not by a long shot. For one, he was a Fed governor way back during the 2008 crisis. And get this, he was only 35, the youngest ever appointed. But the really key thing here, he's a markets guy. He comes from Morgan Stanley, not some ivory tower university. This is a huge deal because the Fed has always been run by PhD economists. It's a massive cultural shift. It also helps that he's been a loud critic of the Fed, which is probably why President Trump called him central casting for the role. And you can really see the difference when you put the two eras side by side. The Powell era was all about stuff we've gotten used to. Quantitative easing, pumping trillions into the economy, data dependence, and of course, the famous Fed put, that feeling that the Fed would always be there to catch the market if it fell too hard. Well, Warsh is basically signaling the end of all that. He's talking balance sheet reduction, forward-looking policy instead of just reacting to data, and a big push for deregulation. It's a completely different playbook. And you can bet the political world is already on fire over this. I mean, look at this letter. It's from all 11 Democrats on the Senate Banking Committee, and they are demanding a full stop to his confirmation hearings. Why? They're accusing the administration of using, and I'm quoting here, pretextual criminal investigations against current Fed members to basically intimidate the central bank into submission. That's a huge accusation that goes right to the heart of the Fed's independence. Okay, so with all that political drama as the backdrop, let's get into Warsh's actual plan. And it's a paradox. It's this strange mix of hawkish and dovish ideas all rolled into one. You really have to get your head around this to understand what he's trying to do. So what does it mean to be a hawkish dove? Well, it's a total contradiction, right? He's a hawk because he hates the Fed's giant balance sheet and wants to shrink it down, but he's also a dove because he wants lower interest rates to get the economy humming, just like the administration does. So the billion-dollar question, maybe the trillion-dollar question is, how on earth do you do both of those things at the same time? Okay, so here's his four-part plan, his big idea for pulling this off. First, he's making a huge bet on AI. He thinks AI productivity is going to be so powerful that it'll crush inflation, giving him the room to lower short-term rates. Second, he actually lowers those rates. Third, he simultaneously starts shrinking the Fed's massive balance sheet. And fourth, and this is a big one, he wants to ease bank regulations to create what some are calling privatized QE. The idea is that big banks, not the Fed, would absorb all the assets the Fed is selling. That's a massive shift of power from the central bank right over to Wall Street. And right there, that's the core problem. That's the tension. When you shrink the balance sheet, you're selling bonds, right? And when you sell a ton of bonds, that pushes long-term interest rates up, not down. So you're pushing one way and pulling the other. It's this incredibly risky balancing act. And honestly, the market is looking at this and thinking, there is no way this works without something somewhere breaking.
All right, so let's get to the bottom line for investors. Every time there's a big policy shift like this, you get winners and you get losers. Let's break down who's who in this new Warsh era.
Okay, so the potential winners? It's pretty clear. The big banks. We're talking JP Morgan, Goldman Sachs. Warsh's deregulation plans and this whole privatized QE thing, it's like it was designed specifically for them. The US dollar probably does well too, as money gets tighter. Now, for the losers, well, it's pretty much everything that loved the last decade of easy money. Think precious metals. Think high-growth tech stocks. Their future profits just aren't worth as much when interest rates are higher. And definitely think high-leverage fintech. And of course, emerging markets that need cheap US dollars to function, they could be in for a world of hurt. And to really understand the stakes here, you just need to look at this one number, $6.6 trillion. That is the size of the Federal Reserve's balance sheet. That is the mountain of assets that has propped up, some would say distorted, global markets ever since 2008. And that is what Kevin Warsh wants to start unwinding. It's a massive experiment. So, what happens now? Well, looking ahead, this road is going to be anything but smooth. From the confirmation battle to actually trying to implement this stuff, the path is just loaded with risk.
Okay, so here's what you need to be watching. First, the confirmation fight. It's no slam dunk. There's already a Republican senator saying he might block it. Second, this whole idea of Fed independence is going to be front and center. Then you've got this talk of a new Treasury-Fed accord. Critics are worried that's code for the Fed just printing money to fund government spending. And maybe the biggest risk of all is what some are calling the liquidity hole. What happens if the big banks can't absorb all those assets from the Fed? You could get a massive credit crunch. And let's not forget, history tells us that changing the Fed chair is almost always a danger zone for the stock market. This one feels extra dangerous.
And this quote here from Senator Mark Warner really says it all. He's pointing out that with these investigations hanging over the current Fed, it's really hard to trust that any new chair picked by this president can actually be independent. It just casts this huge political shadow over everything and makes you question the entire institution. All right, so given all this uncertainty, how might someone try to trade this? Let's just game this out as a thought experiment based on everything we've talked about. The basic thesis is pretty simple. The market is not priced for how wild this could get. Things could go way up or way down. So the play isn't to bet on a direction, it's to bet on volatility. Think about it. If Warsh's deregulation plan works, the big banks could absolutely rocket higher. But if his plan blows up and causes a credit crunch, they could crash and burn. A trade on volatility, something like a long straddle, could pay off big time in either scenario. Now, what's the risk? The risk is that nothing happens. A long, drawn-out political fight where we're stuck in limbo. In that case, volatility just bleeds out and the trade loses money. And of course, we have to say it, this is all just for informational purposes. This is not financial advice.